in real estate, I think it's you have to be a little bit more conservative. Would you agree?
70% of families lose their wealth by the second gen, 90% lose by the third generation. Sometimes it's better to do funds because you have diversification. If you don't have the expertise, then you should align yourself with the people that do. Were you involved in real estate in the last recession? I think that's very good to know. And if they were, the questions I ask is how many properties did you give back?
He advised single-family offices from perfume to yogurt fortunes, underwrote billions of dollars in deals, and built a platform where family offices co-invest together. But the most interesting part isn't the capital. It's the code, governance, patience, and how to choose partners when everyone else looks credible. Today, DJ Van Keuren pulls back the curtain on the quiet rules of generational wealth and what most investors get backward. So, DJ, I'm very happy to have you here.
Oh, Ahmad, thank you for having me.
Let's start with your background a little. I think that you sent me a very, very impressive CV, but I want to know what happened before that. What story of money did you inherit? How did you grow up? What was your initial spark into what money and how the world worked?
Well, I grew up in a small town in upstate New York outside of Syracuse, and might have had 3,000 to 5,000 total people. Our high school was really small, and that made me want to leave and to a broader, open mindset, and to see the world. And so after I graduated, I went down to Florida to play baseball, and that's really what drove me through college, was playing baseball. I ended up playing at Ball State, which was on their Division I baseball team, which was my one of my goals. I graduated and was spent a little bit of time in North Carolina, my first job, and then moved out to Seattle. And through the 90s, I was an advisor, a financial advisor. And I had started to go to Vietnam starting 1996 with a good friend of mine. And so in 2000, sold everything but the house and moved over to Vietnam to co-develop a coffee company. And that was where I was really able to start thinking big and just see the world from a whole different angle. We'd have people that, we'd be sitting around the dinner table and you have somebody from Australia and the UK, from Vietnam, from New Zealand. I mean, you're just getting all these different perspectives, just really opened up everything. Came back in 2003, said, what do I want to do? Said real estate, and formed a private fund to position as the first single family REIT. Saw the downturn coming because I really dove into markets and sold that, went back to graduate school at Harvard. And then after graduation, I was doing a lot of work with various developers. And then when I moved to Denver about 10 years ago, I literally fell into the family office space. And after being there for about 4 or 5 years in that space, I said, this is what I want to do, finally, which was real estate, which I loved, and loved the family office space. And so that's what I've been doing since then, and that's what I'll continue to do going forward.
It's fascinating. You said it took you to go to Vietnam and seeing all those different perspectives to make you think bigger. What was that shock at first? Did someone say something to you that you said, whoa, I really need to up my game?
Well, that's a very good question. And, over there, here people talk about, let's say, opening a franchise, and they're like, okay, I'm going to open up a Subway. Well, over there, they're like, if you're going to make any money, you have to have at least 10. So that's the initial conversation. Secondly, is people that were working for these large companies, whether it's PwC or, big international firms, they're in charge of multiple countries. So it's just not, they not only had Vietnam as one of their countries that they oversaw and managed, but they also had, let's say, Cambodia, and they also had China, right? So all of a sudden, you're dealing with people that have totally different perspectives instead of, well, I just work for this one company. And then there's a very small expat community at the time of about 10,000 people. So all of the people that you met that were foreigners and expats were all at the very top level. So it's just being around, I think, now that I think about it, people say you are who you are, the people that you are around. And I would have to say that was exactly the case in Vietnam.
And did you glossed over, but I definitely want to go deeper of how did that perspective or did that help you understand the market when you came back to the States in '03 so that you could foresee the housing crash?
Well, I'll tell you what it did do is, when I first did my first Excel, for example, it was really bad. It was really, really bad. And now if you look at my models, they're quite sophisticated. One of the things that I learned over there from my partner at the time was to focus and to figure things out. In fact, I went to his house one morning before work and he's just staring at a blank computer Excel screen. I'm like, "What are you doing?" He goes, "I'm trying to figure out this formula." Well, I came back at the end of the day. He's still sitting there in front of his screen. I said, "What are you doing?" He goes, "I'm trying to figure out that formula." And he just wouldn't leave until he did it. So that really had me dive into really details and focusing and the importance of it. And then also, in Vietnam at the time it was a developing country, so you had to have three backups, because if A didn't work, you had to have B, if B, then C, then C, then D, right? So you're always moving forward. So from that perspective, it helped tremendously because it really taught me how to think through things in the much more greater detail. And then, figuring things out. I mean, that first year I read every book in real estate, from late night gurus who were on at 2 a.m. to, a book that I had at Harvard. And it all says the same thing. It's just in a different fashion. And so I think that discipline for sure came about, and interest to understand things and the details from Vietnam for sure.
I connect with you. I actually do the same that you do, in a different dimension, I guess, where I also invest into real estate. I also co-invest with family offices. And when people ask me what is your edge, sometimes I say it's my perspective. And you just made me realize it's because of how I was brought up. I was brought up outside the States, so I also do plan B, C, D, E before I even look at plan. And I assume plan A won't work. Like I already go with the idea that when they show me an underwriting, it's wrong. And I need to think of, okay, what can go wrong, and then analyze every single scenario before I even think of saying, oh, yes.
Well, my question to you too is, growing up, was everything easy and simple?
No, it was completely the opposite.
It was completely right. And in Vietnam, I mean, there was no really rule of law. And it was hard for me the first year to say, for some of the things that I saw, right? But here in the States, everything is so organized. And so, if you want to sue somebody, you sue them. And if you do something you shouldn't, you can get caught and you can get in trouble. And so there's so much to be said for that, to be able to have that experience and that just proves that has impacted and helped you, right? From that background.
Of course. Going deeper into underwriting, obviously you said now you do very sophisticated models and you've underwritten over $5 billion in assets. What are perhaps your biggest levers that you're very careful on and you go into great detail in?
Well, from an underwriting perspective, I mean, one of the things that we do that unfortunately not everybody does is we stress test, right? So if we're thinking that we're going to buy at a 6 cap and sell at a 5 cap, we also look at it to say, well, what happens if we had to sell it at a 7 cap, right? Or if it's a multifamily, what happens if the vacancy goes down to, 10, 11% vacancy? Because historically, it's never been worse than 11% on multifamily properties. But what happens if, right? What happens if we have extra debt that's on there? So it's really just the different levers that we'll look at, and to say, worst case, best case, a base case scenario. And I would say it's all around cap rates, right? It's interest rates and leverage and occupancy.
Yeah, I agree. I think that a lot of underwriting happens at a very superficial level. And most I've seen underwriting from the 100 units times $2,000 in rent equals, like very, you think, okay, that's great, but where's your, like, I like to see everything, but I agree with you. Market vacancy or absorption is one of the two biggest factors that make or break a deal, because I definitely believe that you can change a project, but you cannot change the market. It's very difficult to have a market maker.
No, I agree with you. And when we talk about multifamily, to me, it's very, very easy to quantify because you can actually do a market demand analysis to identify what that true demand is. And a lot of people don't take that extra effort. I've always said that real estate is 90%, academic per se, I guess you could say. And then the last 10% is that your feeling of it, right? If you felt that's not a good spot or good spot, or, that gut feeling is the last 10%. But quantitatively, you can, for the majority, make all of your decisions based upon the models and the data that you have.
Yes. And I think that's just your diligence and doing your homework, right? It's just most people are perhaps superficial because they don't do the diligence correctly. What other mistakes do you feel people do when trying to analyze an opportunity or a deal?
Well, I can tell you this is the biggest issue and the biggest mistakes are ones that we're going to be capitalizing, at least we are, over the next couple years. If you haven't been through a recession, which the majority of people, especially in multifamily, have never been through, anybody made money since 2012. Everything was going up, 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 up until we hit, 21, 22. And then all of a sudden interest rates went up. And, your standard deal that we would be sent would be, okay, we're going to buy a 5 cap. We're going to sell it for 4 cap. We're going to have 3.25 interest only. And then when we refinance at 4.25, right? And that's not the case. And so you have negative leverage now. And, of course, you have some decreasing in vacancy in certain markets or certain areas, but they're upside down. And so I think, the biggest mistakes are really exactly what, I said a couple of minutes ago, is about the stress testing. I mean, one thing that I learned when I started that single family REIT was if I never went below 70%, if I didn't go above 70% in debt, I could lose zero or have zero equity in it. But as long as I'm cash flowing, it doesn't matter. So the value could be worth zero, but if it's cash flowing, it can get through anything. And so you need to make sure that you have that positive cash flow and you don't over leverage yourself. And so, it's a little bit more conservative than a lot of people might take, but that's going to protect you and insulate you.
Yeah. And I guess what you said before is like not using the same playbook every single time. I think people got used to 12 years, 13 years of a good run, perhaps. Even the market's all-time high for 13 years. Like it almost feels like records are meant to be broken. But in real estate, I think it's you have to be a little bit more conservative. Would you agree?
I think it depends. I'm a big cycle person. I think it really depends where we are in the cycle. And you can go back 250 years in the US, the UK, and Australia, and real estate runs in 18.6-year cycles. And, we keep making the same mistakes over and over again, right? So if you look at going into a recession, well, you're having, the leverage usually that's available is less. People start going to preferred equity in order to add additional leverage because they can't get the full leverage in first position, right? And then you end up having overbuilding because during the peak, developers, that's where they make their money. They keep building, right? And then all of a sudden you have interest rates issue and everything sort of comes to a standstill, which, we are going to hit a depression or a recession next year, 2026. I've been saying that for 6 or 7 years. And so during that time, all the inventory burns off, right? The demand in a certain product is there. Banks will be, worried about coming out and providing all the debt again. But once we come out of a recession, everything starts kicking back in, things start doing well, people start building, we start having, more inventory, right? And then you get to the other side where you have too much inventory, and then we start going down, and we just keep doing the same thing over and over and over again. And that's gonna happen again. And I think that you have to look at the macro economics and really look behind us to see what's ahead of us.
I love it. I think cycles are one of the least understood. Even though on paper you look at the cycle and everybody says, "Oh yes, of course," but at the same time, we always think that. I think the most dangerous thing to say is that this cycle is different. Like now it's different because X, Y, Z, and history proves that the cycle is called a cycle because it goes around and around. It's the same. I have something that I was reading about you, which I found fascinating. Can you define patient capital the ways families actually practice it, and not the way that funds market it?
When you say the way that fund market it, could you elaborate on that a little bit more?
Yes. So I find that the market usually has the idea that family offices or families have more patient capital or more flexible capital, and then institutions are more restrictive with their capital. They are, if they have a 7-year window, at year 7 they sell, even win or lose. How do you define patient capital on the other spectrum? Why is family money different?
So, on the institute, a lot of people think family capital is like institutional capital, and it's not. It's actually more like the retail capital. Institution, you have people that are hired. It's not their own money. It's and they're having to put the money to work. I question the fiduciary responsibility of a lot of institutions because they have to get the money out the door. Doesn't mean that they're making the best decisions whatsoever. Whereas with families, that's their personal capital. They don't have to invest it if they don't want to, right? There's not a gun to their head to say that, okay, you need to get this out the door so you can have management fees so we can produce a return for these other people. They can wait, they can hold, they don't have a period of time where you had mentioned where the typical fund at the end of its period, they might get a couple extensions, but at some point in time, they have to sell. And if you were going into the recession and your fund has to sell, guess what? You're not going to do very well. Whereas that family, if they hold real estate, they can say, okay, we're not going to sell right now. We're going to hold off. We're going to hold off on investing, or we're going to hold off on selling, right? And because they're in control and it's their own money, which is no different than you or I or any other type of retail investor, even if they put money into their IRA, they don't have to do that, right? They don't have to have deductions to go on their 401k. They don't have to make an investment. And because of that, they can be more particular. They can be, actually just make better decisions. And so families, they have the money. They're never going to make it again, most likely. So they have to make good decisions, and that's what creates the patient capital.
Interesting what you just said. They'll never make it again.
Very, very rarely. I know I worked for one that he created, the son actually created his own wealth in addition to his father. But, 70% of families lose their wealth by the second gen, 90% lose by the third generation. And it's very rare if you're going to go out and really make significant amount of money. I mean, look, if you've been spending the last 40 years on chemicals and building up that business, and all of a sudden you sell it for $400 million, you're probably not going to do that again, right?
That's true, and I think that puts into perspective family office capital being perhaps even more. Well, it is more personal, like you said. Institutional capital, it's some guy, very trained, very well paid guy to put money out, but they didn't make it. So there's a little bit more, there's less emotion on one side, and then there's a lot more attachment on the other. So it's more careful how money is put out. I like that. So you were introduced to the family office world after Harvard. What was fascinating to you about it? Why not go the traditional route to like Wall Street?
Well, 95% of the people that work for a real family office fall into it. In my situation, I just happened to had moved to Denver from New York City, and about 9 months in, I hadn't met anybody here, so I just started sending out emails to developers just to introduce myself, and people were very kind. They were like, "Well, stop by for a cup of coffee. We're really not doing anything." And then what ended up happening is I ran across a gentleman that when he died, all his money was going to go to his foundation, and he'd only been using his own money. So he had wanted to start taking a look at bringing in third-party capital so that when he died and the money went to the foundation, all the people that help him create his wealth could still have a job. And, they asked me, what do you think we should do? And at the time, all my relationships were with the institution, the Goldmans, the Blackstones of the world. And I said, I knew two families, and I said, family office, because that's really what he was. And, I never looked back from there.
It's fascinating. I think that now you hear more of the term family office, but in that time, perhaps it was a lot more. It was emerging, or perhaps only very few family offices existed. So I think you're humble to say it kind of found me, but I think you were at the right time with the right skill set.
Well, yes, I would have to say that. And, it's really changed over the last 5 years specifically, because now everybody says they're a family office. We have an annual conference at the University of Denver for the Family Office Real Estate Institute. And literally before we spoke, I was going over, let's say, 45 people that applied to come as a family. And we rejected 23 of them because they really weren't a family office. And I mean, that's almost half, and that's significant because they're not. And so it makes it even harder now and days for that word, because people are just using it. But yeah, at the beginning, it wasn't as well known, and the community is very small. And I was fortunate to sort of be taught about the space from a couple, very key people.
Going a little bit more into real estate. Well, we'll do a lot more real estate actually, but I wanted to go more into we talked about underwriting, but now about structuring JVs. What are like 3 perhaps non-negotiables when you look into a JV? Is there any perhaps subtle red flags that you've learned to trust?
Here's the thing. It depends on the type of JVs, because you could be part of a JV syndicate per se where your money isn't going to have any say, right? Or your money, maybe as a family, you don't have the expertise in real estate because you did make your money in chemicals, and that's totally different than a family created their wealth in real estate. I think a lot of it is the standard, whereas, what vested interest does the operator / sponsor have in a deal, right? Because if things go bad, can they just walk away from it? That's one question and one thing to ask. Families are very sensitive to fees, so I think it's taking a look at the structure and the fee structure, and also the track record, right? Which the person you're investing in with the JV is the most important before the deal itself. Because if you have somebody that can't implement, it doesn't matter how good the deal is, right? So
Yeah.
I would say, red flags would be high fees, could be a very big one, or not having an economic interest in the transaction. Those are 2 of the biggest ones.
Do you find
And one more is their modeling. Because once again, if they're saying, we'll buy it a 5 cap, sell it a 4 cap, that's not going to happen, right? And an interest rate of 4%. It's just not going to work. So I would say the model, first and foremost, is going to be the biggest red flag.
Yeah, modeling, I agree, shows how the person thinks, right? The assumptions that they're making. And I liked how you stressed that the person over the deal. This is, I think, most people's mistake. Someone could say, and I always say, someone can say, I want to cure cancer, but if they don't know how to do it, then the product is great or the idea is great, but if the person who's going to execute doesn't know anything, then that's retail. What
Or
about
and you also
go
get
ahead.
some people too that like will come, and you've probably seen it too. They come with this big $100 million deal, but they've never done anything bigger than 5 million.
How do you think about this comes like a chicken and egg problem. You have maybe developing sponsors or growing investment managers that need fees to survive, yet family offices find it unappealing when there are high fees. How do you balance that?
Between high fees and, can you rephrase that one more
Let's say you
time?
sure. Let's say that there's a up and coming, growing developer, and because they are smaller, they need a little bit more fees. Sometimes they don't even make money at low fees. So being competitive in fees ultimately negates their interest in the deal. Is that an automatic no? Or would you say, okay, that's like if someone is great at what they're doing, they're growing, they have a great corner, they have a great product, they've shown consistency, but they're charging an extra fee because of their size. They're just a small sponsor. Would that be something that you'd be like, okay, maybe we consider, or is it a very off-putting when someone has high fees?
Well, a couple things. One is it depends on if it's coming from the retail sector or not, right? Those that are in the broker dealer market dealing with the retail, I mean, the fees are significantly higher, right? And so are they trying to show us a product or an investment opportunity that they're showing people in a different channel is one question, right? Two is families know that you need money in order to run your business. Because if you don't run your business, if you can't run your business, you can't do the deal and you're not going to be able to make the returns, right? So, the way to go about that, if they do have additional fees, is simply to talk to them about it and maybe even try to negotiate some type of a different structure, because there's always sidecars that you can do. And that's typically shown in every type of legal document. I definitely think there's a misnomer from families really understanding what it takes to implement a transaction, because they're not there dealing with, oh, we got a title issue, or we've got, somebody next door saying that we're encroaching on their area, or, I mean, there's just a zillion different things that you're dealing with on a day-to-day. That's what you're paying that person that you're investing with to deal with. So you don't have to. And you have to have the right people in place, which means you have to be able to have the money in order to pay for that. And so I think there's a misunderstanding from the majority of families anyway with fees. I think they automatically think need low fees. But, I also think, I like to go back to say, well, when you had your XYZ business, did you charge a markup? Well, why do you only charge a 2%? Why'd you charge a 20% markup? Well, once you change and the shoe's on the other foot, you look at things differently, right? And
Yeah.
so has to be a discussion.
And thank you for clarifying, because it does, the fee discussion is not management fee only. It's not only carry, but you're right. There's acquisition fee, there's promotion fee, there's referral fees. There's so many fees, and sometimes sponsors who are very fee collectors, I call them, or fee driven, those are the ones that perhaps have to be, I would try to stay away from. Or when I notice that, I do raise a flag, because I'm like, are they doing this for the fee, or are they doing this to make the project great? Because if they're making their money by the fee, to help to the project, like they're not incentivized to do well.
Well, there's not an alignment, right, of interest.
Correct.
And so you do have to be aware of it. But if it's within the market, there shouldn't be an issue. But, everybody's happy when you're making money. It comes down to when you're not, or there's a problem,
Yeah. And you mentioned this word alignment, and it reminded me that your comment about alignment triggered something that I also read about you, about putting people together, family offices investing together. What governance or maybe alignment mechanisms make deals work and what may break them?
Between, you mean between the sponsors and the families?
Or between the families even, because I'm sure that there has to be alignment all around.
So that's a good question, and let's talk internally because that's where the biggest issues come from. The one thing that I've been fortunate, because I have worked for a number of prominent families directly, even as an employee, is understanding the intricacies of dealing with wealthy families. And what I mean by that is that, look, we all have an issue at some point in time with our brother, our sister, our aunt, our uncle, our parents, grandparents, where there's some fighting going on, you know? Well, imagine that, but you start adding zeros, many zeros. Well, that starts getting very complex, right? And so that's one thing, that you have different personalities going on internally, but also what happens if you have on an investment committee somebody that's 50 years old and somebody that's 30 years old? There's a different risk tolerance, right? That 30-year-old might be saying, let's just go into real estate tech. Where on the other end of the spectrum is, no, we just need cash flow. We need to be conservative. So if people aren't on the same page internally, it can cause problems. And those are the things that, that's why relationships are so important with families, is because you need to be able to, work through some of that and just be sensitive to that. It's not just them writing a check. There's other things that they have to deal with.
So how do you suggest they start thinking, let's say an emerging family office or someone with problems, how do they find or should they write a statement of governance, or how do they manage their governance to avoid these issues?
Well, that's a very good question. And one of the biggest things that aren't done in families, regardless of size, is governance, and which is exactly what you said. And it's the game plan, it's the guardrails, it's how the family works together, right? And how decisions are made, and it gets everybody on the same page. And so governance is first and foremost the number one thing that family needs to do. The other thing too is, if you're looking at it from an investment perspective, and the governance is also including not just the financial components, but also what I call the soft side, not the hard side being the investment part, the soft side being things like, how are we going, what's the belief that we want to pass down to the younger generations? What are the plans? How are we going to structure this so that the money continues on? Sometimes there's psychologists that get involved in the whole conversation, right? These are the issues, the soft issues, has nothing to do with the investments. It's just the family as a whole. And when you get to the investment side, very few families actually have an investment policy statement of how they're going to invest the money and in what manner they're going to invest the money, not only in the product types, but also, percentages and how much income, how much growth, the whole thing. So it's a lot more than just them writing a check. It's making sure that they have everything in place that needs to be in place, and it's missed much more than you can imagine.
And you mentioned that even psychologists get involved. Do you suggest that the family comes together around the table, writes something down, or should lawyers get involved? Is there a specialist for this type of thing?
Yeah, the best thing you can do is to find somebody that focuses on this type of planning, because that means that they have put this together for numerous families if they've been around for a while. So they've seen different dynamics, because each family is different, quite honestly, specifically to some degree. And they need to understand those nuances. They need to understand some of the, how the different age groups might react. Attorney's not going to do that for you. You need somebody that just really looks at the whole picture and can help quarterback that. And there's some great people that can do that. And I've been fortunate to meet a number of those that I know are very good, because I know enough just to be dangerous, but they're the ones that need to really, help the families with the proper structuring and what needs to be put in place. And they'll bring in the attorneys, they'll bring in the accountants, right? They're the quarterback.
At the right time, of course. When you look for a family says, I want to invest into real estate, why should a family decide to go direct to a fund or to a club deal?
Well, I'll tell you, 70% of families want to go direct. And the primary reason for that is because they can see what they're investing into, right? Or if you have a blind pool, you don't necessarily know where that's money going into. So it's a control feeling that I'm controlling where I'm putting my money. So, but it's not necessarily all the best thing to do, right? Every time. Sometimes it's better to do funds because you have diversification. And, we had a study done at the Institute where the number of properties that one should have to have proper diversification is 15 properties. Well, that's a lot of individual deals. And so, it goes back to what's comfortable, what their knowledge is, and, where it might fit into their whole planning process.
Yes, I agree with you, and I would take one step further, where real estate is incredibly complex. Each product type is different. Each market is different. Each position in the capital stack is different. There's different geographies. Like, there's just so much diversification that can be done. But I would argue that it's not only about, writing a check in each state with a different product type, with a different sponsor, that generates diversification. It might mean that you might have chosen 15 very bad deals. What's perhaps your suggestion to build a system to be able to allocate money to real estate?
If you don't have the expertise, then you should align yourself with the people that do. That's one way, right? So search out people that, that's all they do and that's all they focus on. That would be one. Getting referrals from families love talking to other families, so getting referrals from other families. The issue that you have, though, as we were initially talking about, is everybody's made money since 2012. So with the exception of the last couple of years when capital calls started coming around, everybody was good and doing a great job, right? Well, we're finding out now who really knew what they were doing, especially if interest rates maintain where they are or go down just a little bit, because banks are finally saying we've got to get it off our books. But I think it's a matter of and also I think asking questions, and a big one is were you involved in real estate in the last recession? I think that's very good to know. And if they were, the questions I ask is how many properties did you give back? Because majority of people were giving back properties. My follow-up question is then, what did you learn from it? Because that's invaluable. And so I think it's just digging deeper to get to know who you're looking to work with.
Yes. And if they were around the great financial crisis, and they're still at real estate, I think they've done something. They're already welcome in the table because they're there. They're still there. Most tourists or people that didn't know got wiped out. And now if you mention real estate, they flinch.
Well, I'll tell you what's interesting is that the people that were through, I can think of numerous operators that didn't buy anything in 21, 22. And those are the real properties that are hurting. But the people that weren't buying those properties were also the ones that lived through a recession in the past. It's not a coincidence that's the case. And now they're going to benefit from all the downturn that's happening. And, we didn't touch any multifamily for the last 7 years. It just didn't make any sense to us. But now, the opportunities are coming.
Was there an irrational investment you greenlit, or perhaps didn't greenlight, but still went through, that you were like, wow, this was so surprising, I learned something new?
Personally or working with somebody?
Working with somebody.
Okay. Because when you say personally, I think of one immediately, actually. But
Then I want that story too.
personally, it was more of a buying Amazon at $12 a share and selling it at $18. Where today, that $1,000, which is all I had at the time, would have been worth $3-4 million. And what I learned from that is, the real money, just like why Buffett's so successful, is because you take a long-term perspective and you don't let emotion get involved, and you just let it go. It is sometimes the best thing to do ever. So that's something that it has pushed over into real estate and everything else. And then another time that investment was made that probably shouldn't have been made. Is that that's your question, right?
Yeah.
On a real estate side, investment that, the only time I would say an investment, it from my perspective, it's come out to be things that you can't control. If you can't control interest rates and they go up, and you weren't expecting that to the degree that they have gone up, I mean, all you can do is try to protect your downside. So at least you're going to get your money back and make something, right? Which goes back to the underwriting and everything that we talked about. But I would say, yeah, I mean, there's a industrial deal I can think of in the past that, probably could have been a little bit more aggressive in the negotiations, right? So that we had a little bit more cushion. I mean, we didn't lose any money. The return is okay, but I think it's at that time we should have negotiated even deeper value.
Have you heard the saying that there are no brave dogs in Wall Street?
No, I have not.
So it alludes to when young or green Wall Street people get into the industry, they have big chests and they're like, I'm going to dominate the market, I'm going to do something good. And then they crash and they make a mistake, and then they become wiser. And then the next time an opportunity comes, they say, no, I'm not going to do it. And then that one's the one that makes money. So it's a saying of, once you get hit by the market, you start to flinch a little and you stop making the bets. But really, making the bets is what makes you the money. How do you overcome that feeling? You had this industrial deal that you should have been a little bit more aggressive on terms. How do you learn from it in a way that it doesn't stop you from making the next deal?
Well, I think it's just that. I think you have to. I think it's a matter of consistently asking yourself. There's a saying, right, which is, I guess, fool me once, shame on you. Fool me twice, shame on me, or something like that, right? Well, you're going to continue to make the same mistake regardless of what it is, with anything, whether it's an investment or even losing weight, right? If you know you're supposed to eat right and exercise and you don't, guess what? You're going to be at that same point again next year saying, I want to lose weight, but you're not doing anything differently. So you're going to be at the same place the year after and the year after. Same thing with investing, is that you have to say, okay, let's look at this and what could we learn from that? And it's a matter of, what we do anytime we've done something, and we always write it down of what we learned from, try to create best practices. At least that's internally what we do.
Yeah.
So that we're aware of it, because for sure it's going to come back and nip you in the butt type of a deal. The one thing I learned in real estate pretty fast when I started was, if you find the perfect deal, the greatest deal ever, and you lose it because, let's say, somebody outbid you, you're going to find something as good, if not better, tomorrow. And so don't worry about it. You don't have to have anything, because something else is going to come up probably a couple hours from now or the next day or two. And so, you have to take out as much emotion as you can.
I love it. I made a mental note. It's like a investment debrief, sort of like write down what went well, what went wrong, fix it for the next time. And I think that's such a powerful practice. And this will be the last question, because I've loved having you here. I think that you've taught me so much. I'm sure the people that are listening are going to be like, I need to learn more. And what you're doing is not only inspiring, but you also love to teach. And there's so much online about you that I think people will go out and read more about you.
Well, thank you very much. That's very nice of you.
So the last question is, what part of your craft, of your work, no one sees but matters the most?
What's the crap that no one sees that matters the most? That's a very good question. I would have to say the work that is really being done when nobody's there, whether it's the thinking, trying to go through of what if, right? We talked about different scenarios, wanting to provide the best for people, right? Whether that's coming to an event that maybe the Institute puts on, thinking through to say, well, of all the events I've been to, what was good, what wasn't? And let's try to make it so that people come and they're like, wow, this is awesome, right? Same thing if we're looking at different deals is what's that, everything that we're thinking through to try to create the best experience and opportunities for those families that we work with.
Wonderful. Thank you again, DJ, for coming, and thank you for giving us your knowledge so generously, and I really appreciate it. And I learned, I'm inspired. I'm going to go back to committee and to our office and be like, we need to think about this more, and definitely we'll keep on learning from you. Thank you again for coming.
Well, thank you for having me, and if there's anything I can ever do, please don't hesitate. Give me a call, send me an email, and I'll do whatever I can. So
Thank
thanks
you
so much for the time.
Of course. Thank you again.